issued by others. And so if you wanted a small business administration loan, you would essentially go to a bank that dealt with such loans, and if the bank would not underwrite you in its normal fashion, and it did offer the alternative of an SBA guaranteed loan, it would underwrite you according to the SBA guidelines, and it would in effect have the SBA guarantee the loan. This makes the bank feel more comfortable and allows you perhaps a little bit more leverage in the process of borrowing money, since you're starting out, and at first banks are reluctant to take that type of risk. So SCORE and also the Small Business Administration are occasionally asked about on the exam. Topic number C under 2 is qualifying agents and licensing. And as I mentioned before, this is the bridge between this chapter and Chapter 2. Because, as we'll find out when we explore Chapter 2, any entity that wishes to do contracting must have a qualifying agent, someone with a license, who's willing to be responsible for the operation. And there you have topic number 2, other business regulation. Topic number 2.3 on your outline is employee payroll regulations, the Circular E. And the Circular E is found in the Contractor's Manual in the 3rd chapter. At the very end of the chapter, there is a collection of pages, and these pages have a separate numbering system, and they go from page 1 to page, I think, 63. And this is the Circular E, the Employer's Tax Guide. Now, you'll want to check with your instructor to make sure that you have the current Circular E that will be tested on as of the date in which you take the test. Now, the Circular E is where you would answer or find information about any questions that dealt with employees or employee taxation. And you can expect to perhaps have one math problem on how to calculate employee withholding taxes. And so you'd want to go to the CRAM reference book to see how that type of calculation is done. From time to time, they ask about other calculations, which we'll discuss as we go through the exhibit. If you start with me in the very first page of the Circular E, you'll notice that we see the table of contents. And you'll notice that they have 16 different topics here. And this can help you in finding out where you have to look for further information. Turn to the very next page, which is page 2, and look at the upper left-hand corner. And here we have the various tax rates as they're being disclosed. For example, and it's a good idea in your own mind, you may have taxes lumped in your own mind into 1 or 2 categories, but there's really 4 items that are being described here. There's the actual tax itself, there's the Social Security tax, there's the Medicare tax, and then there's something called the FUTA tax. If you separate them out in your mind as you do problems connected with them, it'll make the problem a lot easier to comprehend. Now, they're describing here the Social Security tax rate, and you'll notice here that it says 6.2% for each employee, employer and employee. And it says there's a wage base of $68,400. What they're saying here is that you pay Social Security tax at a rate of 6.2%. Now, that's 6.2% that the employee contributes, and the matching 6.2% that the employer contributes. And so there will be a difference in a test question between the question, what is the employee's withholding, and what is the employer's deposit? Because the employer's deposit is going to include the employee's withholding and also the portion that the employer must match. So really the tax here is 12.4%, not 6.2%. But the wage-based issue works like this. You only have to pay this tax up to an earnings level of $68,400. So let's say you earn $70,000 in a year. How much of that $70,000 would you not have to pay Social Security tax on? And the answer is $1,600, the difference between $70,000 and $68,400. And where you need to know this bit of information is if they asked you a calculating question where they were talking about someone who is getting a salary and who is being paid during the last pay period of the year. And let's say his salary is, in fact, $65,000 is the person's salary, and it's the last paycheck of the year. And for whatever reason, the employer decides to give that person a bonus. So his normal salary is $65,000, and the employer gives him a $10,000 bonus in his last paycheck at the end of the year. And so a question might be, well, what are you going to have to pay on Social Security for this amount of money? And what you have to recognize is you're going to pay Social Security on the full amount of the paycheck, the normal paycheck, and that will bring the person's income up to $65,000 for that year. But of that $10,000 bonus, if you add the 10 to the 65, you get $75,000. And there's a portion of the $75,000 that is over the $68,400. If you can do math quick in your head, it's $6,600. $6,600 would not have Social Security taxed against it, and that would be the issue they would be testing you on. Notice back to the Circular E, the Medicare tax rate is 1.45%, and again, the employer would match this, and so there would be a difference between the question, what is the withholding, and what is the deposit. And the third item here is the federal unemployment tax rate, or the FUTA rate. Now, when we get to the appropriate part of the Circular E, we'll describe the FUTA rate a little bit more fully. Okay, you'll notice on page 2 on the right-hand side at the bottom of the page, the next big topic is calendar. And there are key filing times that become important. For example, January the 31st, you're supposed to furnish the 1099 and W-2 forms. You might ask yourself what the 1099 form is, and that's one you'll need to know. That's the form that you would fill out and send out at the end of the year for anyone that was operating as an independent contractor to you. In other words, you don't withhold taxes, you do not withhold Social Security, you do not withhold Medicare. Instead, the individual is working for you, and you are giving them a 1099 at the end of the year to document what it is that you have paid them so that they can properly pay their taxes. Now, the issue of independent contractor is a touchy issue, and when you go to your class, you might want to ask your teacher a little bit about this issue. You want to be very careful in contracting because there's a very thin line in contracting, accentuated by the fact that, say what you will or arrange what you wish to, a person who is doing business in the contracting arena, generally speaking, can only either be a licensed subcontractor or an employee. Now, it is true that you could create the topic of independent contractor. That is, a person who is claiming they are not an employee, and on the other hand, they're not a contractor because they don't hold themselves out to the public. But you have a rough time documenting that relationship, and so you want to be very careful as to how you regard the individuals who work for you, and speak to your tax advisors and set yourself up appropriately. All right, continuing on, there are other deadline dates here that are pointed out for you, and it's pretty self-explanatory. However, look down at the bottom of page 3 on the left-hand side, the bottom left-hand side of page 3. Well, they're talking about April the 30th, July the 31st, October the 31st, and January the 31st. What they're talking about here is the end of various quarters, the 4 quarters in a year. And they're talking about depositing the FUTA taxes, that's fine. But they're also talking under that about filing the 941. Now, where people sometimes get confused is this. There is a difference between filing the 941 paperwork and depositing the taxes. They don't have to happen at the same time. You have the filing of the information and you have the payment of the taxes. The 941 is the filing of the information. And what they're saying here is that at the end of each quarter, you're going to file an information return. But what becomes important is if you look at the upper right-hand corner of page 3, you'll see the last sentence which says, if you deposited all the taxes when due, you have 10 additional days from the due dates above to file the return. In other words, if you did everything you're supposed to do, at the end of the first quarter, you might think your deadline was April the 30th, but your real deadline is 10 days later. The word 10 days later, later means add. You add 10 to the April 30th, and your due date would be May the 10th. Okay, so the due date for the filing of the 941, if you have done everything you're supposed to do, is 10 days after the close of the quarter. Underneath that, under important reminders on page 3, the right-hand side of the page, the first paragraph speaks to the I-9 form. In the chapter dealing with employee regulations, you will also read about the I-9 form. This is the Immigration and Naturalization form. Every employee that you have to fill this form out. The form has instructions about how to do this. And the form is going to document the person's identity and the eligibility of work of that individual. And you must have an I-9 form for each employee in your organization, and you must keep these forms for a specified period of time. And in the section dealing with employee law, you'll find that you must keep these records for 3 years from the date of hire, or 1 year after they leave, whichever is longer, 3 years from the date of hire or 1 year after they leave, whichever is longer, and that's the I-9 form. Okay, the Circular E continues. If you look on page 4, you see a checklist in a big box that tells you what you are supposed to do periodically and annually, and the deadlines involved in that. And there's also a little discussion about information returns, and again, they talk about the 1099 miscellaneous in this and tell you that you must fill one of these out for each individual that makes more than $600 in a year. And then we get to page 5, and on the left-hand side of page 5, we see the topic of record keeping in the middle of that page on the left-hand side, and it says that you're supposed to keep employee records for 4 years. On page 5, on the right-hand side of the page, there's a discussion about getting information by phone and so forth. The test does not ask much about that. We turn now to page 6. Page 6, on the left-hand side of the page, they speak about the employer identification number, and we spoke of that earlier. Every business needs one except for the sole proprietor. The second topic on the right-hand side of the page are who are employees, and again, this is a big issue to several different bureaucracies. The IRS says that employees are defined by virtue of your relationship with them, and so whatever paperwork you have, whatever arrangements you believe you've made with such a person are of junior importance to how you actually treat the person. And there is something of a line in the sand, and the whole issue has to do with whether you control that person beyond a certain point. You see, you can control a person's activities, that is to say the products that they produce, and or you can control the process by which the products get produced. If you cross the line in the sand, if you try to control the product to the extent that you cross the line and now are directly controlling the process by which that person gets the product, in other words, you can tell that person when to show up. You can fire that person. You give that person tools. You give that person a deliberate schedule. You oversee the activities and direct that person minutely so that you are controlling the process as opposed to only the product. Then in their mind, you have crossed this line in the sand, and that individual is your employee, even though in your way of thinking they are not. And they are aggressively hunting for individuals they feel are misclassified, and you can save yourself a lot of aggravation if you plan ahead and decide exactly how you are going to treat the various individuals you'll come into contact with in your business. On page 7, on the lower left-hand side of the page, there's a discussion about family employees, and every once in a while they ask a question about that sort of thing. And then we turn to page 8 in the Circular E, and starting on the lower left-hand side of the page on page 8, they're now going to talk about what does constitute wages and what does not constitute wages. And you'll notice, for example, they talk about the topic of business expense reimbursements. On the right-hand side of the same page 8, they talk about per diem and fixed allowances. They talk on the next page 9 about moving expenses, meals and lodging, health insurance plans, and so forth. And you may need to differentiate what does constitute taxable income and what does not, and you just have to find your way back to this section to do so. On page 11, on the left-hand side of the page, item number 7, they describe supplemental wages. And what's important here is if you look on that section and look at item 1A towards the bottom of the page, it says withhold a flat 28%. Now, when we calculate a person's taxation, normally what we do is we find out how they are paid, whether they're paid weekly or whether they're paid monthly or they're paid twice a month or what have you, then whether or not they're married and how many dependents they claim. And then we go to the tax tables, and in this Circular E, the tax tables start towards the end of the manual. And we look in the tax tables to find out what the tax would be. But there are some situations where we might not want to go through that aggravation. Instead, we might just be dealing in a lump sum, and we might look at the lump sum that a person was paid. And what they are saying here is that if we wish to do it that way, what we can do is withhold a flat 28% from that payment to that person for the tax portion of their tax liability. This does not include their Social Security and does not include their Medicaid or Medicare. So we're dealing only with the tax portion, and they're saying we can withhold 28%. Okay, the next discussion starts on page 11 and goes for several pages. They are talking about how you basically handle an individual and what forms you are going to need the individual to fill out. It'll describe the W-2 and the W-form, what happens if you're dealing with non-wages, and it describes these processes here. And then we get to page 14. On the left-hand side of the page, they describe the EIC, the Earned Income Credit, which is perhaps allowed to an individual, and you fill out a form W-5 in order to see if the person is eligible for this, or the person is eligible, and then you fill out the form. And what you need to know about the EIC is what it is, and also that the employer has a responsibility to monitor the situation. As far as what it is, it's a program where individuals that are essentially borderline poverty are allowed to take a credit against what they otherwise would have withheld from them in their taxes. And that's why it's called an earned income credit. And so you would calculate an individual's withholding taxes, and then you would apply a credit against that withholding, and so they would have a slightly bigger paycheck at the end of the time period. As far as the employer's responsibility, if you look on page 14, down at the bottom of the page, the second paragraph up from the bottom, it says change of status. If an employee gives you a signed Form W-5 and later becomes ineligible for advanced EIC payments, he or she must revoke Form W-5 within 10 days after learning about the change. So that's the question they might ask about that. They do give you an example of how to deal with the EIC, and that's on page 15 on the left-hand side towards the bottom. They indicate an example. They also indicate towards the top another example. They have not asked recently about how to calculate these EIC payments, but they might, and you would just follow the example as it's outlined here in the Circular E. On the bottom right-hand side of page 15, the topic is depositing taxes. And essentially they're saying that you've got several ways you can deposit taxes. If you have a very small amount of taxation, you can follow the two dots that are at the bottom of the right-hand side of page 15. You can actually file or pay at the same time you file the return. In any event, generally what they're going to describe on page 16 is the other rules that apply to bigger organizations, and essentially they say, look, you're either a baby bear, in which case you deposit monthly, or you're a papa bear, in which case you deposit twice semi-weekly, or you're a huge papa bear, in which case you deposit daily. And that's what's being described here on page 16, and what they mean by a look-back period is you just take a look at your past history and see whether you're a baby papa or a big huge papa bear. Another point here is there is a difference in the name of forms. Now the IRS and the Circular E is going to talk about the 941 form. But if you were to look in your Builder's Guide to Accounting and look in the index under forms and look up tax forms in the index, you'll find that it will turn you to a page that describes a number of other names for forms that are the names the banks use for their forms. And every once in a while a question will come along that has you split that hair. You have to know that that section of the Builder's Guide to Accounting is there. It's in the Builder's Guide to Accounting. Look in the index under forms, look for tax forms, and you will see that it lists the 941 as the payroll form to the government, and then several other forms that are the deposit forms to the bank. Okay, turn to page 20 in your Circular E, and on the left-hand side of the page, they're describing what the penalties will be if you deposit incorrectly. On page 21, they have an exhibit of the 941 coupon. And then on page 22, they describe the process of how you actually fill this form 941 out. On the page 23, bottom right-hand side, they describe what happens if mistakes are made and you need to amend your 941. And this discussion continues for several pages, going to page 26, where they now take up the topic of the federal unemployment tax. Now, the federal unemployment tax is a tax that the employer pays, and it stands for federal unemployment tax. And the bottom line is you're going to pay this tax on the first $7,000 and only the first $7,000 of wages that a person earns. And you'll notice that it tells you that the rate of this tax, if you look at the bottom right-hand corner of page 26 where it says computing the FUTA tax, it says the basic tax rate is 6.2%. So if a person made $50,000 in a year, they're only taxed on the first $7,000, and so 6.2% of $7,000 would be the amount of money that the employer would owe. And that amount of money comes to $434. So if you paid your full FUTA tax, 6.2% on $7,000, your tax liability would be $434 per employee. However, the FUTA tax is different in that if you live in a state like Florida that has its own unemployment tax, you are allowed a credit against this FUTA tax. And the maximum allowable credit is 5.4%. So in other words, you have a 6.2% FUTA tax and a full credit potential of 5.4%. And so your actual FUTA tax in Florida, if you've taken your full credit, will be 0.8%. Now that's a very small amount. 0.8% of the first $7,000 comes out to be $56. So for someone earning $7,000 or more, the FUTA tax will be within a range of $434 and $56, depending upon how much of that credit you actually take. If you were only going to take half the credit, instead of 5.4% that you would subtract from 6.2, you would subtract 2.7, half of 5.4. Okay, so the FUTA tax is paid on the first $7,000. It's paid only by the employer. Its basic rate is 6.2. Its adjusted rate, if you take your full Florida credit, is 0.8%. And two other things about the FUTA tax. Suppose I am working for employer A, and I make $5,000 with employer A, and the employer pays the FUTA tax on it. And I quit employer A and go to employer B. Does employer B get any credit for what employer A paid? No. Since I changed companies, there is no continuity, and so it starts all the way again from zero. Example B. All right? What if instead of me leaving my employer and going to work for another, this happens? I'm working in company A, and company A gets bought by company B. Well, now I'm still working in a sense for the same company because I didn't quit. It's just that my company got bought. In that case, there is a continuity, and whatever was paid before the purchase would be credited against that year, and so you would, or the employer would only have to pay the difference as the year progressed. Turn to page 28. On page 28, you have a table that deals with special rules. And so, for example, you'll notice at the top of this table, they're saying, well, on the upper left-hand row, we're going to list the situations or the classes, and then on the rows that follow towards the middle and the right, we're going to indicate whether income tax, Social Security, and Medicare and or federal unemployment taxes are paid in that situation. And there are a number of them that can be asked about, but some of the ones that have historically been asked about, on page 28 in the middle of the page, a deceased worker, you'll notice there's a distinction as to whether a widow or a surviving widow of such a worker receives benefits in the year of the death or after the year of the death. Those situations are treated differently from a tax standpoint. Another area that gets asked about from time to time is on page 29 towards the top, home workers. Another one that gets asked about from time to time is on the next page, 30, retirement and pension plans, and also salespersons. And then on page 31, one that gets asked about from time to time is workers' compensation, all the way at the bottom of the page. So you need to know that this form exists. On page 32, you have sort of a mishmash discussion. This Circular E, frankly, is not as clear as previous Circular E's. They really have not done a better job at differentiating the issues. But what they're describing here is both at one time how you figure out the EIC calculation and also how you figure out something called the percent